A very good afternoon. Let's take a look at the markets. Asian markets experienced a revival following Trump's reciprocal tariffs pause, although uncertainty remains high about the future. Despite Trump levying import tariffs of 125% on Chinese goods with immediate effect, the Shanghai Composite also ended the session in the black. The Nikkei share average jumped 9.13%. The Hang Seng index closed up 2.3%, while the Shanghai Composite Index ended the session up 1.2%. U.S. markets surged ahead in yesterday's trade, with the S&P 500 recording one of its largest daily gains since the Second World War. This after President Donald Trump paused reciprocal trade tariffs against most nations except for China. The Nikkei share, the Dow Jones Industrial Average rose by 7.87%. The S&P 500 jumped 9.52%, while the Nasdaq Composite Index roared back up by 12.2%. All right, looking at our local market now, we see that the All-Share Index is trading in positive territory. It's up 3.2% at 85,143 index points. The Rand is trading at 19.46 against the US dollar, 21.49 vis-a-vis the euro, and 25.05 against the British pound. Still not doing very well. In terms of our commodities, gold is trading at $3,109 an ounce. Platinum is trading at $923 an ounce, while Brent crude oil is up a little bit, $63.40 a barrel. All right, so we're taking a look at this particular graphic, and what it shows us is that at the beginning of trade in the US markets, we saw that markets did open in negative territory. Of course, that was on the back of the fact that the Chinese had announced that they were going to be levying import tariffs of 84% on the United States. And then, of course, Donald Trump then came out with his announcement that he was going to be pausing reciprocal tariffs and bringing the baseline for all countries down to 10%, with the exception of China, which it would levy 125% against. And you can see that from this graphic that the market then suddenly went into green. There is a big spike that we're going to see on that graphic where everything just went totally green and there's no more red for us to see. Of course, we're going to get into the details of what actually happened on the US markets last night with Simphiwe Letlojane. He's an investment strategist at Absa Investments. Thanks very much, Simphiwe, for joining us. So, a few days ago, President Trump was talking about how his tariffs policy was a necessary medicine when markets were really slumping. So what do you think happened to change his approach? Because I hear it had a lot to do with what was happening on the US bond market. It's an area we don't normally talk about, but it is a very important market player.
No, certainly. I think, of course, the importance of the US bond market is that it would be a good proxy for overall sentiments towards specifically the US. And generally, when it comes to US bond markets, they tend to largely just reflect interest rate expectations, inflation expectations, and not a lot of risk premium being priced into US bonds. But we did see a little bit of a tick up in the credit default spread, if you're looking at the credit default spread for US government bonds. So that does speak to a bit of a slippage in sentiments towards the US. Specifically, we are seeing the dollar also trading a little bit lower. And really, it's not so much the bonds, but more rather what it reflects. And of course, investors being a little bit worried about, in fact, quite concerned about the, economic ramifications that Trump's proposed tariffs could have, even on the US economy as well. And certainly, sentiments are that those effects are not necessarily going to be positive, but the overall effect definitely looks to be negative. And also quite a lot of information coming out where we're seeing a lot of disagreements amongst government officials who certainly do not look like they support Trump's overall stance and some of the methods that were even used to get to the tariffs that we saw prior.
Yeah. Simphiwe, I want you to really break it down, because you're talking about credit default swaps, which is, it just goes over our heads. It's too technical. But I want you to talk about what happens in terms of the bond price and its inverse relationship with yields, that is the interest rate, and why that is so important. Because my understanding is what was happening is that when people jump out of equities because of fears, they usually jump into safe haven assets like US Treasuries, like gold. But what was happening is that people were coming out of equities, but they weren't jumping into US Treasuries. And I want you to explain that whole process and why that was happening.
100%. So, and then as you rightly say, in an environment where there's a lot of fears in the market, the US economy traditionally gets seen as a safe haven. So people will buy the dollar, people will buy US Treasuries, in which case, of course, when you're buying US Treasuries, demand for US Treasuries increasing. So the value of US Treasuries would increase, but the yield has an inverse relationship to that. So yields would be coming down as we see more and more bidding for US Treasuries. So us seeing a little bit of a slippage of US Treasuries speaks to people actually selling off a little bit of those, as well as it did correlate quite strongly with the US dollar itself, because as people disinvest, they would disinvest out of US Treasuries, which are denominated in bonds. And a lot of the assets from a safe haven perspective going a little bit more towards gold. So gold holding up quite well in this environment, trading in excess of 3,000. And that's really because, yes, the US economy is seen as a safe haven, but there's quite a lot of concerns around the fact that these trade tariffs could induce a recession within the US. And that's certainly the sentiment broadly, especially given, how aggressive the stance that the US was taking was.
Yes, no, absolutely. Thank you for that, Simphiwe. And of course, he's paused this for 90 days. So like in 80 days' time, no doubt there'll be more jitters and markets will be all over the place. But let's get straight into the issue of the trade war with China. That now looks fully on. How do you see this story playing out? And interestingly, again, the Chinese market closed in positive territory, which doesn't really make sense.
I was saying, look, an overall reprieve across the board. If you're looking at Chinese markets, I mean, even as you mentioned at the start, that US market themselves did see a little bit of a rebound. And that's really because of markets reacting a little bit positively to, the reversals of the trade tariffs that were going to be aggressive against most of the globe. But now seemingly the attention for the US turning specifically towards China. Overall, we do think that the end game, even in a situation where you're seeing such aggressive tariffs between, essentially the largest producer in the world as well as the largest consumer in the world, that will also still most likely affect the rest of the world, both from an inflation and from an economic growth perspective. So not necessarily seeing that scenario as being a positive. It definitely would also not necessarily bode well for the rest of the globe. I think what's giving China a little bit of a better position is that, of course, from an inflationary point of view, they're starting off quite a much lower base compared to the likes of the US, because inflation has been a little bit disinflationary in that market. But certainly from an economic growth, from an export perspective, tariffs of this nature would definitely not bode for that economy.
Yeah. So another inflation threat for us here at home is our local currency. I mean, equities are up nicely. The rand did sort of retrace, some of its losses, but now it's not doing very well at the moment. What is your take on that, and how much do you attribute in terms of local factors vis-a-vis international factors?
I think at the moment, definitely pointing towards a combination of both, but probably the global having a much, much stronger effect. In an environment where there's a lot of risk-off sentiment, there's a lot of fears, emerging market currencies typically don't do well. And our emerging market currency specifically is one of the most liquidly traded, across the globe. So, you tend to see a little bit more volatility in the rand. So volatility in the rand for the next couple of months will probably be the norm, as, there's quite a lot of uncertainty, as we mentioned, that in 80 days' time, one even wonders whether it's going to take that long for there to be another announcement that swings the pendulum in a completely different direction. So a lot of uncertainty at the moment, but one I suppose, offsetting effect, especially from an inflationary point of view, despite that we are seeing the rand weakening, and of course that does induce quite a lot of currency-induced inflation. On the other side, we are also seeing global oil prices. Those have come off quite a bit, of course, with global concerns around global demand, especially if the overall economy globally is heading into a recession. And that would at least, be a little bit of a reprieve from an inflationary point of view, specifically for fuel prices, which tend to affect inflation quite a bit.
All right, Simphiwe, more to ask, but not enough time. We did belabor the issue of bonds, which I thought was quite important. But thank you very much for your time and insights. As always, Simphiwe Letlojane, he's an investment strategist at Absa Investments. After